VC is just one financing vehicle, and it's not meant for every company, and oftentimes VC is the wrong product to building or scaling a company. I know there's an allure and a glitz and a glamour that is oftentimes around it, but the truth be told, when you look at a dilution-based return for an entrepreneur, if your objective is to build a great substantial company and maybe have a chance of building some individual wealth, the journey of selling for $1 billion but taking the dilution profile of raising $300 million along the way is often, you end up with the same amount as if you raise $4 million, scale to 20 million, and are able to sell for a great multiple, but by retaining higher ownership. So I would just say before you raise venture, even more so than ever, be incredibly intentional about what your objective is for the next decade as an entrepreneur and as a company builder.
Welcome to Austinpreneur, our show about the stories that made Austin, Texas a global hub for startups. The show is produced by Capital Factory and hosted by me, Nick Spiller. As a reminder, by joining Capital Factory, you can plug into the ecosystem where the stories on this show were set. Learn more about us at capitalfactory.com. Welcome, everybody, to the Austinpreneur podcast here live at TechConnect 2025. We're going to kick it off. We'll have a few people jumping in, I'm sure, as we go, but let's dive right into the conversation since it's time. I want to start off by introducing our special guest for the session. He founded a company called Jebbit when he was in college at Boston College, subsequently dropped out, raised $90 million, and then sold it to Vista Equity here in town. Transitioned to become a venture capitalist. He started his own pre-seed venture fund that's focused on space, defense, and energy, otherwise known as Frontier Technology. His portfolio companies have raised over $1 billion. That's quite impressive. And he closed Fund 2 in 2024, last year. So without further ado, I want you to join me in welcoming the general partner of Space VC, Jonathan Lacoste, to the Austinpreneur podcast.
Thanks so much. Appreciate it.
Thank you. And for those of you who don't know, the Austinpreneur podcast is where we dive into the stories making Austin a global hub for technology, entrepreneurship, and innovation. Where one of our great partners is hosting this event, ATI, and I want to thank ATI for giving us this opportunity to talk about VC funding in 2025. I'm going to kick it off, ask Jonathan a few questions, and then the audience will have an opportunity to ask questions too. So think about what you want to know, and we'll try to get as many of the audience questions in as possible. So, but Jonathan, let's dive in.
Sounds great. Thanks for having me.
Well, first things first, you've now raised money as an entrepreneur and raised money as a venture capitalist. How is it different raising money as a VC than back when you were a founder?
It's similar in some regards. I think when you're raising a fund as a VC, the thing that might get lost on people is you're asking to kind of raise a blind pool of capital in the sense of investors often don't know the exact specific companies or the terms in which you'll invest in. So raising a venture fund is much more similar to an entrepreneur raising their pre-seed or seed round, where it's very much based on the team, the market, the vision, and the articulation of that. As you go deeper into your venture career and you're raising Fund 3 and 4, then the track record starts to speak for itself. Very similar to if you're a startup and you're raising a Series B, C, and D stage, then the growth metrics and burn and churn start to speak more of it as well. So there's a lot of similarities. And then, the one thing that's really unique about the venture business is at the end of the day, our clientele are essentially our entrepreneurs that we work with. So when you're diligencing a venture firm, a lot of the referencing is essentially with the portfolio companies they are spending time with. Whereas obviously when you're a founder, it's other companies in the ecosystem, it's your clients, it's a different type of reference profile.
Yeah. I've always thought the word blind pool is a little derogatory. It's like a little aggressive. It's not totally blind.
Mysterious box of capital that could go in many directions.
Dependent on the individual who's investing your money would be more fair in my opinion. And so as a founder, you're raising money from VCs. Who do you raise money from as a VC?
So when you're starting out, like my first fund was very small. It was a micro VC fund. And so oftentimes it's other entrepreneurs, other VCs, family offices. So these are individual investors. As you move up the venture capital chain, so now a lot of our investors are institutions that are institutional fund of funds that invest capital in emerging venture capital funds. And then the next step is endowments and pension plans and things of this nature. So a lot of the big venture firms that you're likely familiar with, their sources of capital are endowment pensions, foundation, and increasingly sovereign.
Yep. Before we get more into your VC, like, looking back on your time as a founder raising money, what really led to your success raising 90 million, almost $100 million with Jebbit?
I think the honest answer is that our journey, it spanned over 8 or 9 years. It was not up and to the right immediately, like many of the headlines that you might assume oftentimes entrepreneurial journeys are. And so for us, if I had to sum up the through thread, it was tenacious, hard work, and kind of a never quit mentality. That said, early on, we certainly surrounded ourselves with great angel investors and mentors that had been on the path that we were on to help advise us about the journey ahead. And so I think we tried to be incredibly coachable and pairing that coachability with the work ethic so that we could always learn and iterate more quickly than maybe some of the other competitive companies that we're up against.
It takes a long time to build a successful company in the venture space. I think people see it and they see things like I'm saying, you raised $90 million. It's, but the time and the effort over a decade is hard to really put into words. It's a little bit of a get-rich-slow scheme, if you will.
I mean, even these days, you see the headlines of AI companies and how quickly they're growing. And I do think, in one way, startups have had the ability to never grow more quickly. But just because we're so new into this cycle, there's a question of revenue durability and how long that revenue stays versus a more traditional SaaS company where stacking enterprise contracts or SMB users took a longer period of time. And so I do think one of the interesting questions or trends is, does the time to build a kind of mature company in startup land, is that compressed with AI? Or do, the peaks and valleys, are they just more accentuated early on in the journey, just given distribution and access to technology?
What do you think the answer is?
Probably a little bit of both. I think some companies will, go from 0 to 100 million very, very quickly, but we'll find that there was a lot of trial usage underneath that customer base, and then others will use that as a jumping off point to acquire and consolidate market share.
Right.
So like most things, the answer is probably both.
There's the one that crashed and burned because they had developers in India instead of AI.
Oh yeah, Builder AI?
Builder AI.
Not in the portfolio, to be clear.
Watch out for the service as software instead of software as service. That'll get you. It doesn't work at the end of the day. It amazes me that someone could raise $1 billion when they don't even have the technology. I don't know what happened in that. I don't know anyone in the deal, but it's amazing. It's kind of an amazing feat in and of itself that you could get away with that. But I don't condone it.
I don't know any of the specifics, but I think it probably, at least from our lens, speaks to the competitiveness and speed in which venture is continuing to move.
That's right.
When I was raising capital, our Series A, this was a multi-month process, building relationships with individual VC firms, sharing status updates, kind of the more traditional way that you would think about raising venture. Now these fundraising cycles are so compressed that it doesn't surprise me that mistakes or omissions like this, or a lack of ability to do real deep diligence, not suggesting that's always the case, but certainly more of these use cases will likely appear.
That's right. There's so much money going into the AI space. It's there's a premium on the top deals, and the VCs have to go fight to get into them. And just like a few years ago, people were skipping inspections on their home to come buy a house in Austin. Similar effect.
Yeah.
With the VC funded companies.
And we were just talking before we went on stage about the dynamic of the early stage market right now, and looking at some data from Carta and tracking deal volume and how many startups are raising their pre-seed and seed and Series A and the total capital. What you're seeing is a real dichotomy in a lot of these markets where the top competitive deals, a subset of that, call it the top 5 to 10% of startups, are raising at exorbitant valuations and an extreme amount of capital. And there's a larger cohort of what I would say historically, if you look at the bell curve, are average or laggard type of startups, really struggling to raise capital. So I think the bar for venture has just raised across the board at each stage, because these 0 to 100 million growth stories, every VC has seen one of those. And so your company as an entrepreneur, whether you know it or not, in a different sector, it's kind of an opportunity cost.
Yeah.
You're pitted up against that.
Yeah, the data's a little confusing because I guess just 5 years ago you had the advent of all these mega funds and mega deals, $1 billion, $2 billion funds writing $100 million checks. This wasn't happening 10 years ago. It's almost like a different asset class. And so as much as the top line numbers of the amount of funding look pretty remarkable, and even the deal count remains neutral, I think you're kind of talking about two different ways to finance a company, which is like, we're going to go pile $1 billion, multiple billions of dollars into this startup and still do the venture thing where it becomes a unicorn, highly successful. But I think the more traditional venture capital funds, I think yours, what, a $22 million fund that you're investing out of? That's about what Capital Factory's fund is. I think even more traditional venture funds are $100, $250 million funds. It's kind of just the math is way different, right? Because us as VCs, we need to return 3 times the capital to our investors that we get off of it. And so if we're investing out of a $20 million fund, the return profile is much different than if we're investing out of a $1 billion fund. And so I think that's such a key thing to figure out when you're investing.
I think venture today is fundamentally 2 different products, both to entrepreneurs and to investors in venture funds. We call them LPs, limited partners.
Yep.
But ultimately, you have the mega platforms, which I was on the phone with several of them this morning. We collaborate closely with. You need to if you're in the ecosystem. But the product to entrepreneurs is much more around to the venture firm. If you're a multi-stage firm, investing $4 million out of a $2 billion fund or even a $1 billion fund is an option call.
Yep.
What you're effectively looking at is building a portfolio of options in which to eventually back up the dump truck of $1 billion within that fund to try and bring leverage. As an LP, you are the endowment, you're head of private investing at an endowment or a foundation. Your job is to deploy $500 million into a venture capital fund. You're looking for a very different return profile, oftentimes 1.5 to 2.5x, compared to the other side of the venture ecosystem is much more a craft business, which we would call like traditional venture, which is probably more of where you and I sit on the spectrum.
Yep.
The return profile that LPs are looking for are way more around higher upside, but more limited dollars that they can put to work. The other thing for entrepreneurs is I think, ultimately it's best to have both in your camp, but for a smaller boutique craft strategy, you're likely dealing with domain experts, much more handheld, kind of personalized approach, former operators helping you get in the weeds and build the company, recruit, find customers, things of that nature. And so many startups at the top end now are trying to balance the dynamic and sequencing of when do I raise from kind of traditional venture, when do I raise from these more scaled platforms? And I think we'll continue to see that dynamic evolve.
Yep. Yeah, and there's actually, I think, a third category where you've got the classical VCs, these mega VCs, and you also have the angel investors, which have a little different way of thinking about it because a lot of times it's not their job. They're doing this because they want to. No one's, we have an obligation, a mandate to go invest. Angels don't. They don't invest through a fund. It's just every investment is kind of a one-off deal for them. And so, and so there's these different ways of thinking, different structures. It's all getting lumped under one umbrella of venture capital. But I think and even the VCs are writing really small checks compared to even the ones that we might in the classical route. And it seems like the important thing is just knowing who the future investors in your company will be. Like for us as VCs, and then as founders, when you're raising money, like who is going to fund this company in the future? If you're raising money from angels, is your deal still set up to be attractive to investors like Jonathan and Capital Factory and the classical VCs? And is there a way down the road is there a way down the road that you intersect with a mega round VC as well, and kind of understanding your odds at that? And I think there's the answer could be both. You can put together a successful life cycle of a company just raising from angels, and there's companies that'll raise $2-3 million from angels, maybe go grow to $10-20 million in revenue and sell for $50 million or something. That can be a home run. I don't see it happening very much anymore. I think it happened more. But that's totally within the realm of possibilities. And then same thing, raising from smaller VCs, you can still remain capital efficient, and just raise for maybe you just raise $20-30 million for your venture, and that gets you to a successful outcome that makes sense. Also, don't see a lot of that happening. And I don't know if there's a hard and fast smart reason we want to go raise as much money as possible, or just we want to go do it because everyone else is doing it. But certainly if you get $100 million check from some major venture fund, you're not doing bad either.
100%. I'll make 2 points on this. One is I think if you're a startup or an entrepreneur and you're raising venture capital today, compared to when I was doing this for my first company a decade ago, that was much more of an art of persuasion, finding VCs, educating them on the marketplace, and persuading them of your technology or vision. Today, it's much more about matchmaking in my mind. The ecosystem is so much more fragmented that, yes, there's persuasion involved, but if a VC doesn't instantly understand your domain, your technology, kind of your surface area, the point being there likely is one that has that type of fragmented or specific view or ecosystem that they're focused on. So VC as an asset class has just grown tremendously. And so the first thing I always say is, find people that already share your worldview, and ingratiate yourself with them and keep them up to date on your progress. The second is, I think this was obvious as a founder, but even more so as a venture capitalist now. VC is just one financing vehicle, and it's not meant for every company, and oftentimes VC is the wrong product to building or scaling a company. I know there's an allure and a glitz and a glamour that is oftentimes around it, but the truth be told, when you look at a dilution-based return for an entrepreneur, if your objective is to build a great substantial company and maybe have a chance of building some individual wealth, the journey of selling for $1 billion but taking the dilution profile of raising $300 million along the way is often, you end up with the same amount as if you raise $4 million, scale to 20 million, and are able to sell for a great multiple, but by retaining a higher ownership. So I would just say before you raise venture, even more so than ever, be incredibly intentional about what your objective is for the next decade as an entrepreneur and as a company builder.
Yeah, I think just take your time to understand the options that are out there. What kind of debt vehicles might your company have access to? What is VC? I think coming here is a great step. There's a lot of books that you can read, and and I think if there's people out there building incredible things and are incredible entrepreneurs that would have no problem raising money, it doesn't mean that they're super financially literate or understand this stuff, and ultimately that's just going to work against you when you go fundraise by not knowing that stuff. So try to study up. All right, so your first company, we've been talking about a lot of the trends and the changes, but really the growth in venture capital the last few years. And we touched a bit on fund size here, but let's go over to the sector and the industries we're focused on. Your first company dealt with helping people with consumer brands, is that right? And zero-party data, or how would you describe it?
So we started a company in college that effectively was an observation of how much we hated online advertising. And so I was 17 when we started the company, and so oftentimes your first entrepreneurial endeavors are what you immediately have exposure to, or the problems or annoyances you have in the world. So yeah, it was aiming at helping large enterprise brands and governments collect consumer data in a more compliant manner that would help you personalize digital experiences. What was interesting is, that journey was started in 2011, and this was the time where people were really asking questions around if Facebook could become a mobile-first platform, and then in 2014 and 15, you had Snapchat emerge, and this concept of personalization was still pretty cutting edge because the underlying data wasn't there as an asset, and so it was an interesting journey. If I'm being incredibly honest, it wasn't my life's passion, which is obviously why I'm doing something very different now. But it was an incredibly interesting business. I started it with a few friends in college. It gave us some incredible experience. Have a lot of empathy for software businesses and long enterprise sales motions and what that takes. But certainly it's a very different time in 2025 than when we started the company.
Yeah, and I think that is very characteristic of a lot of companies you saw raising money in 2014. That I'd say all the way up until around 2019 is these software, consumer web centric businesses. And when you went and started a venture fund, you made a distinct choice, and Capital Factories made a similar move of kind of evolving beyond the consumer internet into deep tech, frontier tech. Why did you make that decision to invest in space, defense, energy, versus just going and funding more software companies? Yeah,
it was both a personal and a professional decision. So I think the observation I made at the time was venture had over-indexed and over-rotated towards SaaS, and especially these kind of consumer web SaaS-type companies.
A little too sassy.
A little too sassy. And so on the back half of that journey, I was starting an intellectual exploration of my own of meeting people in space, defense, energy, kind of robotics, broadly speaking, and kept leaving those conversations confounded and confused by why classical big venture wasn't spending more time focused on these areas. I also thought, and we can get into each individual sector, there were very compelling tailwinds for why the world would need structural disruption and change and venture to play a larger role in these ecosystems, especially space and defense at the time. And so the observation and bet on my part was founders earlier on in their journey, especially at pre-seed, oftentimes really are seeking former founders turned VCs to be a partner in crime to them early on in the journey. And so the observation was one of, these sectors are incredibly important. They've been largely ignored by venture. And we think having operators in our network partner with these early stage founders could be a really compelling product and opportunity space.
Yeah, and it feels like a lot of the industry has gone the same way too, and evident by your portfolio companies raising over $1 billion, and so you're obviously investing. You're not investing a ton. What, $1 million, $2 million?
Yeah, $1 to $2 million.
$1 to $2 million when you first get involved, and so relatively small amount of capital. What are you looking for? Like, what have you done to get you in these deals that have gone on to raise hundreds of millions of dollars?
I think the honest reflection looking back now is that none of the companies looked incredibly obvious or fit a narrative at the time. But in retrospect, they look very obvious. And maybe that's how a lot of venture plays out. And so when we're evaluating a pre-seed deal, oftentimes it's at incorporation stage. So we've had the chance to meet the founder before they've started the company or as they're thinking about starting the company. We've had a chance to underwrite him or her, the founding team, the co-founder set. But really it's about understanding their view of the market and then the technology risks specific to that company and the product roadmap that they're willing to take. And so for us, it's team, market, and technology roadmap. Those are the three ways that we evaluate it. But a lot of the companies that are now breakout companies at the time, in 2022, we wrote the pre-seed check along with Peter Thiel and a company called True Anomaly. They were doing spy satellites that spy on other satellites, essentially. That was not necessarily kind of defense-oriented investment, and now it's incredibly obvious, and they raised a ton of capital. Similar with Castilian, we were the first investor in a company called Castilian that spun out of SpaceX. They're doing hypersonics from a projectile standpoint. At the time when we wrote the investment, no one thought about going head-to-head against the primes in one of their largest R&D dollars where they've raised tens of billions. That company's doing exceptionally well. So it's just about finding these pockets of meeting exceptional people with a vision for the world and an important tailwind and reason for why the future will look different than the past, and having conviction and betting on them.
Yep. The future will look different than the past, and that's one fun thing about our industry is it's not you're not just crunching numbers and looking at historical data. You got to really go out and make a bet, and a lot of the things that you see getting funded, there's not really a one-to-one comparable company out there. You can kind of draw some comparisons to do your diligence, but I firmly believe that the unicorns of tomorrow will look much different than the unicorns of yesterday. All right, I got some brass tack questions for the entrepreneurs out there so we can help them be successful in fundraising, and then we're going to open it up to y'all and ask any other questions you might have. This is your chance to ask some zingers to Jonathan I might weigh into, but mainly on him. So in your first meeting, like, how do you want that to go? Like in a really good first meeting with an entrepreneur, like talk us through what that looks like.
I think there are some precursors before that first meeting that help set the stage for success.
Yep.
I prefer a deck in advance.
Same.
Before I hop on a call with anyone, I try to be incredibly well read. I want to understand your frame of mind coming into the call, what you're building, who you're selling into, just the ecosystem that you exist in. So I always appreciate when, before the call, I've already had a chance to kind of get up to speed on the company and the founder. It doesn't have to be a deck, but just a memo, some body of work that articulates what you're pursuing.
Any red flags that you think are common in the prep material, the deck, or anything they send you that
Yeah,
you might avoid?
a lot.
All right, let's name a couple top ones.
I think the one that's probably most transferable across different categories is depth of thinking or shallowness of observation. I think it's, even if I haven't spent time in a particular technology domain, it comes across more evident than you might think in terms of the level of depth that someone has really explored a problem set. And I'm not even necessarily looking for a particular solution or the right answer. I'm just looking for someone who's been deeply thoughtful and has tried to understand the problem from all different angles. And so that oftentimes can or cannot come across in a deck or in memo material.
Goes back to my thing about being well-read, and certainly in your industry too, I think is what you're getting at. And if you're not the smartest person, or one of the smartest people in your space, especially in deep tech, frontier tech, is going to be hard to raise money. And so coming across that way is super important. And then same thing, kind of reading up, knowing what venture deals look like, knowing the financing, I think is another way to help move things forward and just avoid any red flags before you even meet the VC. And
yeah. But on that first call, I mean, oftentimes I prefer I prefer for shorter, more casual, free-range conversations. I'm looking to explore and understand the founder's background, what got them intellectually excited about potentially spending the next decade of their career on this problem set. I don't want to go through slideware. I want it to be as informal. I want to prod. I want it to be back and forth. I always appreciate when entrepreneurs bring interesting questions for VCs. I feel like too oftentimes VCs can lob the questions the entire time, and there's nothing reciprocal. So I always appreciate that. And I think just through that conversation, just like any other conversation in life, you pick up on a lot of cues. And I think early on, what we're looking for is intensity of focus. We're looking for coachability of the founder. We're looking for thoughtfulness of the problem set, creativity maybe, and how they've arrived at the problem. And so those are all just on a very personal level. Because again, we're investing, no product, no revenue, day zero. And so you have to look for those signals that are founder driven, because ultimately the product may change, the market they're selling into may change, but what oftentimes does not change is the founder itself.
And most likely will at that stage will evolve to one degree, if not a lot. And so a lot of what I'm hearing is like, it's not just the outcome, it's not just your idea, it's the thought process, the philosophy, and even the drive behind what you're doing. And
yep. But this is where going into matchmaking, like every venture firm is going to give you a slightly different answer. And so this is just a data point of one. This is my personal style and my viewpoint on the world, but other venture firms will give you other viewpoints. I think the one added element that's important to know before you go on a call with a VC, or at least to learn before you leave, is what their investing strategy is and the cadence of deals, not just check size, but how often they're writing checks and their portfolio size. And so how this plays into our conversations is we are what's called a high conviction fund, which means we're not going to have 100 investments in a portfolio. We're going to have 15, which means we have to be extra judicious as we're thinking about writing that first investment. And so it means we're likely going to say no a lot more than the average venture firm, and that's okay. But it's just about matchmaking and finding, an entrepreneur and a VC that have a similar shared view of the world.
Yeah, and I think you gotta really, know what you gotta find out if you can spend a lot of time with these people, and it's like at the end of the day, it's I think that's what's universal for all different venture funds, especially ones that are going to lead around, get on your board. You're probably, I think a lot of founders are there trying to, convince them this idea is a great idea, when like in reality, I think like most of the ideas I get pitched are pretty good ideas, and if I could like snap my finger and make that idea come to life, we would make money as an investment. But it's that journey of how you get there, and it's that journey of understanding that this investor, you're probably going to be working with them on especially with Jonathan, a pre-seed venture investor, is probably going to be working with you on a weekly basis, if not a monthly basis, for years to come, if not decades to come. And so as much as we want to find the best idea, it's also like you just got to find entrepreneurs you can work with, that you can spend a lot of time with, and ones that you think can go out there and raise more money in the future. And so much of that comes down to just the personality, the attitude, and the mindset of each entrepreneur. So.
Yeah, I will say I think most pitches that we receive, I actually think are interesting and good ideas that are worth funding. And there have been many times where I've sincerely been disappointed that we couldn't get there on an investment, and I've actively rooted and tried to help the founder or entrepreneur along in their journey otherwise. We can only partner with the 4 or 5 best ideas and opportunities we see each year. Yep. And so it does unfortunately leave us in the position of, saying no and being, disappointing people a lot of the time, but I think that's part of the job.
All right, so let's dig a little deeper, and then we'll hand it over to the audience. So you've got this, even before you take a meeting, you're looking at the deck, you're setting up via email or text the call, and looking for people that have really thought this out, can articulate their vision. You take a meeting, someone who's conversational, that you can go back and forth with, that has questions for you, and not necessarily just someone who's trying to pitch you, get through their pitch deck, and kind of convince you of that their vision of the future is a good one. Okay, so got through the first meeting. Like, talk us through your process and any key things that you're looking for from there to narrow it down to the 4 or 5 that you can really get engaged with each year.
I think knowing that our process involves a company that is pre-product and pre-revenue, there's going to be less traditional diligence than from a standard venture firm of a demo of the product, seeing the facility, talking to your customers. Like, those are traditionally kind of diligence items that you would see. For us, we don't invest in anyone that we haven't spent substantial time with in person. So that means jumping on a flight, spending time in person, both in formal and informal settings over a meal. I always believe, just like in life, you get to know someone a lot better when you can have a multi-hour conversation, understand their hopes, their dreams, their challenges, things they're scared of. Like you mentioned, when you're investing at pre-seed stage, I almost think of myself as an extension of the founding team, as a Sherpa that's here to help guide them as much as possible to the next stage of the journey. And most of my founders I talk to on a daily basis. And so to your point around high touch, like you want to make sure that there's alignment, or at least there's just like in marriage, there's an excitement about spending that much time together.
That's right. Some people say it's as serious as picking a spouse as picking your VC. And I don't know if I'd go that far.
I wouldn't say that's my wife, but I definitely spend a lot of time with many of
my wife listens to the podcast.
Yeah, 100%. But yeah, I mean, ultimately, it depends a little bit on how familiar with the technology and the domain we are. If it's something that oftentimes it will be in a category that we haven't invested in yet, but we've spent a lot of time thinking about. Those are some of my favorite conversations, because the entrepreneurs, oftentimes they always leave the conversation and they'll remark to us like, this has been so fabulous. You skipped all the 101 questions, and we like really dove deep into the things that I'm debating as CEO of this company, like which way to go. Those are my favorite conversations. Yeah. Other times, if it's a category that we're newer to, then maybe between those meetings, we're spending time speaking to experts, both technology and commercial, in our network to try and really sharpen that lens of what's the opportunity here, where's the vision of this ecosystem going, where do we feel like the founder's strengths and challenges are. And then for me, it's really about understanding the 18 months after we invest, how crystal clear or what are the pivot points in that journey and how thoughtful the founder has been. So, okay, great, we give you $1 million or $2 million. What are we doing with that? Who are we hiring? What facility do we need? What equipment do we need? What are the key technical risks or commercial risks? How are you thinking about kind of those different journeys? Again, these are just part of our process, but that's where we really enjoy spending time with founders and hearing them articulate what their thinking is.
Awesome. Thank you so much, Jonathan. That's great insights. Let's turn it over to the audience. I see we have a question already. I'll bring a mic. So when you ask a question, if you could wait to grab the mic so we can catch it for the podcast. If you want to be featured on the podcast, feel free to introduce yourself briefly or just ask a question.
Hi, my name is Valerie Harmon. I'm the founder and CEO of Namaka Algae. We're doing disruptive technology development for precision ag. We're applying it to algae cultivation and going to produce ingredients for aquaculture feeds. So my question for you is, you mentioned that one of your red flags is looking for depth of thinking and that you like to see an upfront deck. And I would like to know how you evaluate depth of thinking from a deck.
I think
it's a deep question.
Let's tie it to the business that you're building, not knowing a ton of context about it, but understanding what are other competitive examples of folks that have tried to grow synthetic or organic algae in the past. What are the uses of that? What are the challenges of other feedstock or different biofuels outside of algae? Like if someone was trying to solve a similar problem set, just understanding the full scope of opportunity outside of the specific business that you're building, I think shows depth of thinking. And so, again, you want the narrative to be tight. This isn't a research paper report. And so, I think the balance, like anything, is not boiling the ocean, but also, showing that we have this opportunity or a gap that we've identified in the market. When we speak to who we think our potential customers are, they've articulated that they haven't tried this before and here's why, or they have tried this before and here's why it did or didn't work. Here's how we're thinking about leveraging that insight into our business plan or our product roadmap. Just things of that nature.
Yeah, I think it's probably a matter of including the right information, not the most information, right? And I and especially so much of the deep tech comes from science, backgrounds, academic world, and the way you present ideas and projects in academia is way different than how you present them to a VC. And I think the deck is the first step. And so many deep tech companies like show me a deck that looks like it's from a research report, and it's just a little too much. I think you try to add your brand to it, and then lighten it up, and then hit the key points, right, and touch on the narrative. And present the important pieces that really give, kind of what Jonathan's saying. I think it's like what makes you really unique and really differentiated from everything else in the space is an important piece. And one tactical piece of feedback I always give entrepreneurs that may help with this, may not, but is to really use the header font in your deck to send a message. I think you kind of see this template format. It's like, okay, the first slide is the problem, the second slide is the solution, then there's your traction, then there's the go to market, and people use those. That's like what the title of the slide is. It's just like, you don't need to tell me this is the problem slide. Like, I kind of know that's what comes first. Like, tell me what the problem is in the header, and then that actually allows me to access the information much more quickly because that's the most valuable real estate you have on the deck, right? And when I look at the feedback or the DocSend report of how many seconds people spend on each slide of the deck, it's usually like 2 or 3 seconds per slide, and they might spend like 30 seconds on one slide where you have a lot of information. And so there's a good chance that all they're reading is like the header or like the biggest font on the slide, especially the first time. So use that. And I don't know if that's like proof that you're thinking deeper, but it might make us think you are. So yeah, a little.
One thing to add, just a tighter answer for you. I think 2 things that are really critically important when I read a memo for a new company I'm evaluating are, why does this technology matter, and why does it matter right now? And whatever the initial response and the framing of the answers there, just keep double clicking on that. So why does it matter now? Hey, there's this interesting tailwind or transition to technology. Okay, great. Why? Why is there that interesting transition? What's leading to that? So just being able to unearth and think several layers deep will help me as a potential partner get to the same conclusion or understand your perspective more quickly.
Thank you. Yeah, right next to you. Oh,
Turn it off. Thank you.
awesome.
Hi, Lisa Carnival from the Ocean Tech Hub in Rhode Island, related.
Awesome.
I actually had a question. You say that you fund about 4 or 5 annually in the end. I imagine, and then you also spend a lot of time really understanding the company before the meeting. Could you tell us how many meetings you might take in a year? And then what actually gets someone to the point where you will spend time researching and reviewing their deck because they have a meeting? So how do you even say yes?
So we see a couple thousand decks a year. I'll take hundreds of meetings. I will take 10% a second meeting. So the first to second meeting is probably where, well, the decks to first meeting is a big transition point, and then first to second is a big transition point too. So obviously the one thing that for large firms, small firms, we have the same amount of is time, obviously. And so especially at pre-seed stage, we have to move very quickly. We have moved as quickly as probably 3 or 4 meetings in a process in a 2 to 3 week window. And we've also, my most recent investment was a founder who I worked with on effectively helping formalize the concept for 6 months before they left SpaceX and started the company, so that once they incorporated, 2 or 3 days later, we wired and helped start the company. And so you have different journeys, but yeah, typically thousands of deck, couple hundred meetings, and then maybe 100 follow-up meetings.
So for the 1,800 or so that you don't take a meeting with, are you mainly passing because it's obviously not in your wheelhouse? It's either too later stage or not in the right sector. Is there any
At the deck level?
Yeah.
There's a lot of filtering out of just, this is probably, I have a ton of empathy for entrepreneurs, and especially as a former founder, I give the benefit of the doubt to founders all the time. The only thing that sometimes does get me a little flustered is if someone is launching the next great e-commerce platform, that's awesome. But if you spend 2 seconds looking at my LinkedIn or the website, it's super clear that we do frontier tech, deep tech. And so there's a lot of filtering out of just folks who are clearly blasting out to a lot of VCs, which is fine. But some of that will obviously tune out.
Yep. So mainly just saving everyone a little bit of time.
Yeah, it's either stage specific or sector or geography.
Right.
And so another example is we have one investment. The top space tech company in India is actually one of our investments. It's a longer story of how we met them, but they spend a lot of time in Los Angeles in that ecosystem. And naturally, as part of my fund's thesis, we're probably not going to be writing another dozen checks in India, but we get a significant amount of deal flow from the Bangalore, Mumbai tech ecosystem. So sometimes too, it's more around geographies where we may or may not be looking to spend more time.
Yep. In general, I think if you're in the wheelhouse of a VC and you have a legitimate team put together, you should be able to get a meeting. And like we take a lot of meetings, it seems to me most of the ones that are passing, it's just like we're able to tell based on the deck why it's not a fit, and we move on because we're very busy. All right, let's move over here to these guys.
Yeah, just going down the line here. So you're next over here, I think. But Bill Provenier, I'm CEO of the innovation space. So we're help support entrepreneurs at the earliest stages, both with capabilities and investment. I'm curious, working with a lot of people myself, it seems like, especially in the deep tech sector as well as the early stage, is the mysterious definition of a lead investor and how you work with syndication, right? It seems like there's fewer and fewer people, it seems like every day, who's taken that leap to do the due diligence and sharing that. And I don't know how much you do in syndication, but maybe if you can talk about, I presume from your knowledge, you are a lead investor, and how do you syndicate with others, work with others, and maybe just a general concept of lead investors. What does that look like to you, and where is that taking us? Are there more today than there were 10 years ago, or are there less today?
Yeah, great question. Well, first I'll start by saying if you don't raise capital from Space VC, then you should definitely talk to Capital Factory or vice versa. So obviously great partners. Early stage is more complex than ever before. There's more players. What I will say is the definition of pre-seed and seed has really changed too, and so you really have to think about what you're actually trying to raise, how much. There's a rise of what I call mega seed rounds, which are essentially $15 million out of the gate seed rounds from a multi-stage firm. Like, that's a very different syndicate and lead type of investor you're looking for than a $2 million round. So we are happy to lead. We invest independently, where we'll take the entire round and just be the partner, but it really depends on the size of the round. So we're oftentimes looking for entrepreneurs that are raising $4 million or less in their round. If they're raising 7 to 10 to 15 out of the gate, that's not going to be a fit for our specific fund strategy, but other VCs will. The way that I approach it is I try to come to independent conviction on just, do I think that this founder opportunity is worth investing in, and would we write a standard check size for us in that opportunity? Then, depending on the founder's plan, whether it's $1 million or $4 million, in that range, then we could start to think about a syndicate. Oftentimes I try to think about what are the biggest challenges that this startup will be posed with that we want to try and de-risk by bringing in other VCs that might specialize in that area, if it's not something that we directly invest. So as an example, if it's a company that's going to be selling into the DoD exclusively, and the founding team has solid but not exceptional connectivity within the DoD community, we might be looking to bring in a pre-seed venture firm that has that type of connectivity and defense tech ecosystem background, right? If it's a lab spin out from academia, maybe partnering with a VC firm who has done those types in that particular technology field before. So it's just about, in my mind, it's about personalizing the VC syndicate based on what the founder and the startup needs.
And at Capital Factory, we always follow a lead VC, so we don't ever lead rounds, except for some rare exceptions. We define a lead, one, by the person who sets the terms and negotiates the terms of the round, often coincide with like a full traditional diligence process. We also qualified as someone who's investing over half of the round, and meaning that we want to see someone that's like really coming in and taking the lion's share, putting a lot of capital to work, and it's not necessarily like a party round per se, which I don't think there's any problem with party rounds. It's just not really what we invest in, but versus like someone might do the diligence, negotiate the terms, lead the round with like 10% of the round, and that's not quite what we would call it. I think it's just the industry's become so competitive, and there's so many companies out there that have already raised venture funding. I think we went from, this is not approximately, I think it went from like 7,000 companies that are venture backed in the US probably 5-6 years ago to like 40,000 right now. And there's kind of like a log jam of trying to raise follow-on capital and see all of those companies to exit. So you're kind of competing with these companies that are already, the VCs have skin in the game with, even though there's, there are, I think, more funds, more people in the industry, and everything's growing. So,
thank you.
Yep. To your right, I think we had keep it going, and then all right, we got one more behind him, and then we'll bring it back over here and try to
quite
spread
coordinated here, right? So thanks so you said you're kind of active at the pre-seed stage. So for the follow-on round, how much of that do you play a role in? And do you want, let's say, the entrepreneur also to kind of keep going and actively seeking external capital? And then I'm from Ottawa, and I run an innovation group at the University of Ottawa there. So, Japreet, thanks.
Awesome.
Awesome, great, welcome. Yeah, we look to follow on some of our companies. It's not 100%. I think obviously there's context there. So yeah, when we're partnering with founders, we make it pretty clear up front, and we discuss together kind of their mutual capital fundraising plans. And so we would be looking at the seed or the Series A to bring in not only other external partners, but where we spend a lot of time is with the multi-stage VCs. And so yeah, the short answer is yes, especially if they're jumping from a $2 million round to a $10 to $15 million round. The role that we play, or that I try to play a lot of the time, is as a silent quarterback or sounding board to that process. So obviously, this is one of the few areas where I feel like VCs probably know that ecosystem slightly better than entrepreneurs, just given that we're spending time interacting with all of these other firms. So what I try to do is be really helpful and methodical in crafting the firms we are going to approach, understanding the context of which partner at that firm might be the best, understanding what they look for in their process, and so just helping set up our founders for success when they go to market, so it's not completely cold and they're cold inbounding or outbounding different firms. We try to hand a warm introduction to them and give them context along the way.
Good question.
Thank you. My name is Tlalipula Bafana Chabalala. I'm from South Africa, startup entrepreneur. My question to you, as a former founder and now a venture capitalist, is what happens to the companies that aren't so successful after you've invested in them? And how else can we reimagine innovation in terms of from taking a product to the market and not finding the right market? What do you do then? Because what I do is iterate on ideas. So it's just existing ideas, and then I find different markets where I've been that actually works. I'd just like your opinion on that.
Yeah, I think we've been lucky in some regards in the sense of we've been operating as a firm for a little over 4 years. We've had one company shut down in that time period. And so luckily, to your question, the majority of companies are still thriving and doing well. But even within that, there's a spectrum, obviously. I think what I always try to do is just be really conscious of where the founder is at in their point, because as you mentioned, I was a founder beforehand, and there were some very tough parts of that journey. I just try to approach every conversation with a lot of humility, understanding what they're looking for. Also, to my prior comment, I also understand too, let's say we invest in a company and it's going well, but not spectacularly well. I also try to be really honest with the founder about what I think the reaction from the investor market will be if they try to fundraise, and be nimble and augment our company building plans to that point. So, at the end of the day, even for a concentrated fund like ours, we have 15 portfolio companies in each fund. Larger funds will have 30 to 50. This is the entrepreneur's only shot on goal, right? 100% of their equity is in this company. And so I try to defer to the founder, and if they want to turn profitable or try and kind of grow more slowly but more profitably and more lean, I would embrace that. But that's probably a unique perspective you'll get from the venture community at the early stage.
It's a great question. You really got to fail with the founders, and we're kind of on the other end of the spectrum at Capital Factor. We are the most active VC in Texas, one of the most in the country. We don't write large checks, but we write about one a week. So we make about 50 or 60 investments every year. We have a portfolio we've worked with over 1,000 companies since we got started, and we're really good at touting our successes, and we've got over a dozen unicorns in the portfolio. But as much as you kind of take a second and you look at the wins and you're like, wow, this has been successful. A lot for me, I've been on the team for quite some time. It feels like it's a lot of failure, and it's and you got to really maintain those relationships. And yeah, I think it's like a lot of how I would measure us as a VC is how we fail with founders when things don't work out, which is a lot of the time, at the end of the day. And yeah, and that's because we want to go and be in a position to go fund that founder's next venture, and that's really how we view it. Is even we're backing a founder. We want the company to be as successful as it's going to be. The reality is at some point we're going to realize this is not going to be a successful company. You got to see it to an exit. It's a lot harder to see it to an exit if you raised a shit ton of money and got a board and everything, and got to help the founder through that. We're not on the board, so we're all pretty aligned. And then and hopefully go and be one of the first investors in their next company. And there's dozens of entrepreneurs we can say we've done that with. And we've got, I think there's one founder right now that we've invested in twice, and both of them have gone to zero, and he's starting his third company, and I'm saying third time's the charm. All right, let's move it over to this side of the, all right, perfect, yep,
Cheers.
back here.
Thank you both so much for this great conversation. Stephen Wood, I'm a patent attorney and space lawyer with local firm Bella Wood, and I'm curious to hear your perspectives on IP strategies, especially with frontier tech, space, et cetera, and whether patents are a requirement or can trade secrets be an investable prospect for you? Cheers. Thank you.
Yeah, great question. Yeah, I mean, at the end of the day, you have to have some type of IP or patent strategy for most of our companies. I will say at the pre-seed stage, there's different levels of maturation around codifying that. Where it's probably most important is sometimes where we've seen academic work or funding programs lead to commercialization of technology, and just making sure that there are really clear IP agreements with the universities or programs that have funded some of those commercialization has been really important. But I don't know if you guys deal with this more than us, but
I think because we're always following, there's yes, I think there's generally IP. We don't dig into it as much as like the lead investor would. I think the key thing where I see people get tripped up is they don't have their licensing ironed out with the university. And we were just looking at a company, and I kind of realized they hadn't even really started the process licensing it, and they're kind of out there like representing themselves, and it's just not good. So luckily, our companies work with a lot of great law firms, much like Vela Wood and a bunch of others to take care of that. And I know it's a big thing, but I'm not as much of an expert in it. So, awesome. All right, in the back.
Hi, my name is Matt. I'm from Spitfire Defense. We make really fast drones that hunt fighter jets.
How fast your drone go?
550 miles an hour.
Damn.
We also we're going to re-enter them from low Earth orbit to attack anywhere in the world. But my one question was, when you were first starting up, what was like the darkest moment when you thought it was all going to fall apart, and how did you persevere?
at my company.
Yeah.
I won't get into the specifics of what it was, just because it involved the passing of someone and a very deeply personal set of experiences for us as a founding team. And so, I think on the surface that should be fairly self-evident around. It also coincided when I think we had a couple of weeks of cash left in the bank, so it was just a series of unfortunate events, I suppose you could frame it as. I think in those moments, it's where you really come to just be really thankful for your support system. And I think both in personal and professional life, that's really incredibly important. And so as cliche as it sounds to talk about startup culture and employee culture and talking about your mission and the values and all of those things that feel a little hand-wavy at times, it's in those moments where I felt like our intentionality and investment in shaping and framing and having a really high bar around who we brought into the company, I was most thankful for. And so I think, the transferable advice would be just be really intentional about the people you bring into the company. At the end of the day, startups are a collection of individuals and their hopes and dreams. And so the more that you can have a really high bar for talent and co-founders or early employees that you can bring in, I would say, hopefully you never go through those moments, but you will always face adversity, and you'll just be really thankful for the great team you have around you when you do.
Thank you.
It's on the hardest days when you know you've got the right team, because they'll show up and keep working. I think I don't have a great answer to the question, but I know that it's some companies, when stuff gets rough, they kind of lay down, and then other companies stuff gets rough and they kind of show up. So all right, one more question. Who wants the honors of closing us out here at the Entrepreneur Recording TechConnect 2025? Presented by ATI. Someone right here, pink shirt.
Hey, thanks. So, just to kind of fit in with the tenor of the prior conversation. So I'm working with a startup that's deep tech. The founders are they're experts in the field, but they're not young, right? And actually, I'm trying to find them a set of mentors. And I'm not quite sure where to look even to find them somebody like you, right? That could maybe at least talk to them once, see what evaluate, kind of their approach and their skills, and then maybe point us to someone that can help them in the way that you've helped some of the founders that you've invested in, kind of develop the business plan and focus on product and kind of, asking the hard questions. So I was just kind of curious, how does, if I'm one of the 4,000 companies sending you a pitch, right? How do we get from that to the place where we have a trusted advisor in this process?
Well, I think the honest answer is you're probably not going to feel that trusted advisor type relationship until post-investment or very close through that process. That said, I try to be very gracious with many of the companies we interact with and offering introductions or recommendations along the way. What I would say very tactically is there definitely are a series of craft boutique venture firms that, as we were discussing earlier, that focus on deep tech, and not all of them are going to spend the time or maybe be able to get them on the phone to speak with the founders that you're mentioning. But reaching out in a very personalized, specific way, referencing other investments they've made, referencing the good news about VCs is they love to talk. So listen to a podcast, read a blog post, go on their Twitter or X or LinkedIn, find some comments about the way that they've viewed the world and tie it maybe to the technology trend of what you and the founders are referencing. That is going to increase the likelihood that you can get someone's time and attention for a key moment. And then I think in that time period, based on the context you provided, I would just be really open-minded and kind of question-oriented if there are questions around the direction to take it. And I think some VCs will lean into that more than others. So that's some quick thoughts.
I think it's a phenomenal question. I have a few thoughts I'll share to wrap us up. I think one is, if you find a VC that's an active VC and they give you critical feedback, cherish that relationship, because I think you're rarely going to actually get that. And a lot of the mentality, whether you like it or not, is to not give a lot of feedback because you kind of risk offending the founders, and a lot of the entrepreneurs that I think come raise money, they're a little bit jaded and they're a little bit frustrated and they're on pitch 50 and they haven't raised money yet, and if you tell them their baby's ugly, it's not going to do me any good, because I want to maintain the option to invest in the future, right? And it's probably too early for me, and so I want to, and so I think you want to look for that feedback, that mentorship from people that have visibility to venture deals, preferably like the last 5 years because of all the changes we've made, but aren't like your actual target investor. That can still be kind of tough. When you're doing that, I kind of throw geography out the window and just kind of try to find who can go provide this advice. And don't take advice from the bad people. The reality is, there's a lot of people in the startup community giving advice that they don't really have grounds to give advice on. And there's a lot of people that will give fundraising advice who haven't been at the table, haven't negotiated these term sheets, haven't raised money, and they still somehow just part of their brand is to give feedback. And that's total dogma that you shouldn't buy into. And there's a lot of great, and if you're in somewhere where it's hard to connect with people, or you're just struggling from a networking standpoint, and some people it's just more natural than others to go out there and do it. It's there are formal mentorship programs. We run one at Capital Factory. I think a lot of other groups have really great programs, and kind of signing up for speed dating type programs can lead to some really good mentorship. But I think it's a great question, because it's once you get a VC, you kind of unlock this world of insights that the venture industry has. The reality is it's pretty hard to get it from a VC before they invest, just because they're spending a lot of time in the companies they invested in, and they're trying to maintain the relationship. But I think if you haven't been to Capital Factory, check us out. And, we've got an awesome membership, and even if you're not in Austin, we have a virtual option so you can still meet with mentors. One of the main changes that I like from the pandemic is a lot of the mentor meetings happen virtually, the first meeting, and so you don't have to come down and do it in person. You can follow up, meet in person on the second, third meeting, things like that. So Yeah, well, on that note, I want to thank everyone for coming, and why don't you join me in thanking Jonathan Lacoste from Space VC for coming on the show.
Thanks so much.
Good stuff. Thanks for listening to this episode of Austinpreneur. Don't forget to check out capitalfactory.com to learn more about us and join our community. If you have thoughts about the show or ideas on how we can work together, reach out to me directly via email, nickspiller@capitalfactory.com. Shout out to the Capital Factory Dream Team for making this podcast possible, and special thanks to Aaron Handworker, who masterfully recorded and edited the show. Come back next week for a whole new episode.